Welcome everybody. So this is Arun from Harmonics Traders. In this webinar, we are going to discuss about the various option strategies. To start with, the greatest advantage of these strategies is, first of all, you don't want to know too much technicals. Okay, of course, you need to know very basic technicals for trading. But here, when you're deploying option strategies, especially these spread ones, it is not mandatory to have sophisticated technical knowledge. You need to have very basic knowledge, and most or at least 80% of the option strategies comes with limited risk, which means you don't want to worry too much when you are carry forwarding your position, or you don't want to monitor SGX or whatever external factors are happening outside the marketers. You don't want to be worried very much. But when you are going like a naked option buying, of course, if you have bought CE, you would be just looking at SGX, anticipating for a very big gap up opening. And if in case by any chance you are holding CE and SGX is at -100, you will not have a peaceful night, right? So those kind of things will not be happening with respect to the option strategies. So that is a very great and biggest advantage. And it is very easy and simple to learn. Okay. So we'll begin with the very basic funda. So what are the things you are supposed to know with respect to the options? So this is the agenda for today. So we'll discuss about what are the option geeks, or the basic terms which you are supposed to know with respect to options, and we'll be discussing about spreads, the spread types, and all these spreads would be having their own advantages and disadvantages, and finally some practical examples like how to make use of those spreads. We'll get started. So these are the commonly used option Greeks, and among these you need to master, or you need to know too much about Delta and Theta. Okay, so those two are the commonly used option Greeks. I'll explain like why they are very much important to both option buyer and seller. Okay, so basically the option Greeks measure the sensitivity of the options price with respect to the underlying asset. For example, let us say you are trading in Nifty option. So the option Greeks will tell you how far the particular Nifty CE or PE is going to change with respect to changes in the spot. Okay, so whenever spot changes, not all the CE increases equally, or all the PEs decreases equally, right? So what is the parameter, or what is the basic mathematics with respect to the option strikes and the movement? That is what the option Greeks are defining. Okay. And of course, they do help investors as well. If in case you are holding, let us say like 1,000 quantity of stock in cash, you could, and let us say that is the lot size, you could just go with selling a CE 10% above. So there are a lot of advantages once you know the option Greeks. So these are the option Greeks which we are going to discuss. Among all the option geeks, the Delta and Theta, these are the two most and crucial ones, especially the Theta. This is for the option buyers. In fact, the option sellers always love the Theta, because Theta is always in favor of option sellers. Okay, so buyers, we need to master the Theta so that we will not be facing losses. Why? See, whatever happen, every second, every minute, the option premium would be keeping on eroding or decaying, right? So we have to ensure whenever like we do option buying, quick immediate reversal or breakout is going to happen in our direction. Those things we'll discuss in detail. We'll get started. So basically, Delta measures the rate of change of option premium based on the movement of the underlying asset. Okay, so how much the premium is going to increase? Let us say like Nifty is at 1800. You have bought 1800 CE. Okay, so if this part moves by, let us say like 50 points, how much this 1800 CE is expected to move? Definitely not 50, right? So it should be somewhere around 40 or 30, right? So those kind of calculations or those kind of movements, whatever it is being dealt, that is called delta. So delta represents the change of option premium based on the movement of the particular in a stock, strike, or the asset. Okay. Gamma, it is like a little bit of technical, so it measures the change of delta. So how far this change is happening, that is being measured by gamma. Vega is nothing but the rate of change based on volatility, or the VIX. So we all know right now VX is somewhere around 14, 15. It is very much lower compared to the previous years. So I believe like around 70 or 80 it was at the Indian VX was trading during the time of COVID. Means too much fear, too much panic, and the premiums were extremely high. Even if you remember, Nifty at the money CE, it would be somewhere around 300 points premium. Okay, so imagine how much premium would have been there at this particular time. So these are all being measured by the Vega. Finally, theta. So this measures what is the impact of premium based on the time left. For example, let us say like we have 5 days to expiry. Okay, so this 1800, let us say 1800 is a spot and 1800 CE. This will be, let us say, like around 120 points premium. If we just go for the next day at the money, it would be somewhere around say like 90 or 80 point premium. And finally, on the last day, it will be somewhere around 30 point premium. Again, this is based on the VX. If in case VX is more, the at the money premium, even on the expiry day, it would be greater. So all these are measured, or it is defined by the theta. Okay, now we'll move on to the next. So this is delta. So we will not spend too much time with respect to these geeks. So last time we spent too much time on this, and we were not able to focus on the main one. So let us discuss with respect to the important ones. We'll start with some hands-on, and then we'll go to the theory part. Okay. So again, delta, as mentioned, it is going to measure the sensitivity of the option price with respect to the particular price changes. Okay. In very basic term, let us say like if Nifty moves up by 1 point, how much the particular option strike is going to move, that is called as delta. Okay, let us say like Nifty spot moves by 100 points. If in case the particular CE moves by 60 points, then delta is 60 divided by 100. Okay, delta is 0.6. So when somebody says this particular CE has a delta of 0.6, it means for every single point movement, this particular CE changes by 0.6 points. Whether it is increase or decrease, it will be changing or it will be moving at this particular pace. So this is called as delta. Okay, so this is what mentioned here. So how many point the option strike is going to change for every 1 point change in the underlying asset. And of course, we could use make use of this delta for various hedge strategies, which we will discuss in the coming slides. And delta always lies within this particular range. Okay, -1 to +1, and 0 to 1. Put -1 to 0. Okay, so if in case it is closer to 1, we can say that is ITM or in the money option. So what are in the money option? Let us take the same example. Nifty spot 1800, 18,000 CE. So this is called in the money. 1800 CE. This is called at the money, and 18200 CE. This is called out of money. Right. Likewise, the opposite for put. 18200 is in the money, 1800 is at the money, and 1800 PE is out of money. So whenever we go with this in the money, the delta is almost 1. So in general, I always recommend intra option players to play in ITM. Reason is, of course, if in case you are using good technicals, and if you're going with intra, whenever the delta is close to 0.9, you could make good profits, assuming your direction is right. But if you go out of money, you need a good amount of movement. When I say like good amount of movement, at least 50 to 100 plus points movement in Nifty to make a decent profit. But that is not the case with respect to ITM. Of course, SL as well comes that fast. Like I said, if in case you're good with technicals, and if you're an intra-index player, you should be doing ITM. Reason is here the theta decay is always very less. Okay, the OTM theta decay is always more. So until otherwise very big or violent move happens, you will be in trouble when you're going with option buying out of money. Yes, option buying out of money we can do when when you're doing positional trades. Okay, when yes, from here Nifty is going to move at least 400 to 500 points movement in this expiry. If you know, or if you're able to do such calculation, yes, you can go with out of money and you could carry forward as well. And always carry forwards, try doing out of money and not in ITM, because the risk is very huge. So all these are whenever you are going naked. But when we do with spread, we don't want to worry about any of those stuff, as the risk is limited when we go with spread. Okay, now just remember this. If needed, just take a screenshot of this particular picture as well. Okay, so ATM in general, the delta is somewhere from 0.45 to 0.55. So C, the delta is always like positive, and P, the delta is like negative. And ITM, it is very closer to 1.8 to 1. Okay, and deep OTM, it is almost 0 or 0.3. Okay, so just remember these default delta values for ITM, ATM, and OTM. Gamma, so it is measuring the change of delta. That's it. Okay, and remember, gamma decreases when it is deep in the money or out of money, because the theta does not have a very big role to play in. So gamma does not come over there. Vega, it measures the changes with respect to volatility. Theta. Okay, why theta is very important? Like I said, by default, every second, every minute, the options value should be decaying. Okay, so by default, let us say like 1800 Nifty spot, and you are buying 18,000 CE. Okay, let us say it is somewhere around 130. It means already you are worth 30 points premium, which means you are going to lose this 30 points irrespective of anything in the expiry or in the coming days, right? So you need a push, or you need a movement in Nifty at least greater than this 30 points or 40 points in that expiry, so that you can make a decent profit, right? So that is the part of theta and ITM. So this rho, so this it is not coming into play in our market very much, because it is like directly proportional to the interest rates. So in our market, basically theta and delta are the most important parts. Okay, so before getting started with spread, like I said, we'll do some simple example, and then we'll come back to the spread. So spread is basically you are going to buy or sell either same CE. When I say like same CE, CE, PE, or PE. So it comes in multiple combination in very simple terms, very simple terms. Let us say you think market is going to fall. Okay, let us say you're thinking market is going to fall. So we will initiate a bear call spread. When market is going to fall, do you need to sell call or do you need to buy call? What do you want to do? You know the market is going to fall. Okay, now do you want to sell CE or buy CE? Yes, you need to sell the call, right? Perfect. Yeah, if market is going to fall, you have two options: sell CE or buy PE, right? Okay, now let us say you are selling CE. Okay, so the first challenge is you need huge margin whenever you are going with option selling. and let us say you are not able to close it in intraday, and night SGX is plus 200 points. Now your loss becomes very big or kind of unlimited, right? We don't know how far it is going to happen, right? Now, to prevent this, what we are going to do, yes, we have shorted a CE. We will also buy a CE. So that even if in case it's a huge gap up opening, some max is needed. Of course, I'll just show that this CE buy, it will be giving us profit. Of course, this selling will be giving us losses. So that overall we have a fixed loss. Okay. Now with this idea, okay, so you can go to this particular website, define it. Yes, it is free, and you have like multiple options. Just go to this option and select strategy builder. Okay, now let us just go with this particular idea. So our assumption right now is market is bearish. Okay, I just want to give one practical example. That's it. Okay. Okay, so now we are going to initiate a spread. What spread? We are going to initiate call spread. So we'll start with call spread. Okay, right now it is at 18,027. So what I'm going to do, I'm just going to sell the closest CE, and I'm just going to buy the little next CE. Okay. So what I'm doing, so right now Nifty is at 18, spot is at 1827. So I'm just taking this particular week expiry. I'm selling the nearest CE 18,000 for 124 rupees, and I'm buying the next CE for 71 rupee 1800. And always remember, with respect to spread, in general, try to go with strikes of 100 in Nifty, because the volume will be decent and high always here, and that will give us a lot of advantages. Okay, now, so what is this showing? It is saying maximum profit we can get is 2,600, and maximum loss we can get is 2,390 or 2,400. Okay, and break even is 1852. So what does it mean? So as long Nifty is trading above 1852, we are safe. So this particular expiry, if in case Nifty trades above 1852, so we will be no loss, no gain. If in case it is somewhere around 1800 or 18, let us say like, yeah, 18200, we will be in loss. Now, how is that loss calculated? Again, just see. So this is your input, or this money you are receiving, right? 124 you have shorted, and you are receiving this money, and you have gone long and you are paying this money, right? Now credit is something 124 minus 71, that is the credit. So whatever happens, that is the max profit. Okay, and whatever happens, loss is nothing but 100, because we have chosen those strikes, right? The strike difference is 100. 100 minus credit, that is going to be the maximum loss. Fine. Any doubts here? So before initiating the trade, we could check everything, and the biggest advantage here is the margin needed is just 23K, right? So 23K is the margin needed to initiate this particular spread, right? Now, as long Nifty is below 1852, we don't want to worry. So we will be in trouble only when Nifty goes above 1852. Okay, now any queries you have with this particular spread? I'm going to do some calculation. So before that, so this is the very basic step. If you believe like market is going to fall, you are going to take the nearest CE, you are selling it, and a little far away CE you are going to buy. Okay, and always remember, very simple funda, selling value, whatever you have shorted, the value should be greater than buying value. Okay. So kindly shoot your queries. Let me take 2 or 3 minutes and move on. Okay, net credit is nothing but 124 minus 71. That is the net credit. So net credit is 53 points. Okay. So that is what you're seeing it as profit 2600, and the max loss is 100 minus 53, that is 47 points. Okay, now I'm doing some adjustments. So this is the safest and default decent one. And here the other advantages. So 22K capital, and you could either gain 10% or you can lose 10%. Right? So this is weekly expiry. So let us assume it is going to happen in our direction. We would be able to make 10% on weekly basis, if in case our assumption is right and we are going to make profit. Okay, now I'm just going to do some changes. Instead of 1800, I'm buying 18200 CE. Let us see how these numbers are going to change. Right now 2600, 2300, right? Once I just go with higher one, can you see the profit and losses are changing drastically? So earlier it was 2600 and 2.3K. Right now it is like 4000 rupee profit and 5.6K loss. Why? So here I have increased the gap. So whenever you're increasing the difference between the strikes, your profit and losses would be increasing. Okay, fine. And the break even, you have like a little higher break even. Okay, but still your loss is coming as 5.6K. Right, and here again the margin needed in all the cases, it would be almost the same. So if you just see, you need to risk 25% of your capital, right? So this is what happens when you are going with, when the strikes, they are at huge difference or better difference. So don't do this in general. Okay, so just try to keep the strikes as close as possible, 1800, 18200. Okay, or like let us say like 18,000 P, 17,900 PE. Okay, try to keep the strikes as close as possible. Again, so all these things you could just play around on this site. Okay, so just you have to just do this adjustment. So this is a sample example like how we could initiate the spread, and before entering into the trade, we could see all the things, and then we could initiate into the trades. And so what you're going to do, you should first buy and then sell. Only then you would be able to do, because if you sell directly, it will be asking you 1.5 for like 1.3 lakh margin. So before initiating spread, just go for buy and then go for sell, so that you would be able to do that. Why can't you buy a higher strike CE? Okay, so see, right now our assumption is the market is going to fall. So your question should be, why can't I buy a PE? Yes, we can buy PE. Okay, yes, we can buy PE. The basic idea of the spread is to have a limited risk. Of course, if you are buying option, if you are doing intra, yes, the risk could be limited. But when you are carry forwarding, you can't limit the risk, right? So whatever premium you have put in, whether CE or PE, you need to risk the entire premium. You can argue like, yeah, I'm going to buy out of money CE, which means let us say like I'm going to buy a PE for 40 rupee. My risk is 40 rupee. But again, winning by buying out of money and carry forwarding it regularly, the probability of success is very, very less. Okay. So yes, it can win 1 or 2 times, but not all the time your OTM is going to win. Okay. So here again, when again you can't initiate spread at your will, so you need to know the basic technicals or very basic fundamentals. I'll just share some examples like where yes, one could initiate the spread. So now I assume you guys are you have an idea about like spread. Now we'll move with the details of spread, and again we'll come back to this particular page. Okay. Okay, so any spread where the call is being used, it is called as call spread, and any spread where put is being used, so that is called as put spread. Okay, so what are the advantages with respect to spread? Again, option buyers can use spread to reduce the risk. Let us say like you are doing in ITM and you are going to carry forward. Okay, so let us say like you are buying 150 rupee C and you are carry forwarding, your loss is 150 points. But when you do via spread, the loss becomes somewhere around 70 points. And of course, with respect to spread, the profit as well decreases. That is an notable disadvantage. But our ultimate motive is to reduce the losses. Okay, for that spread are going to be used. Option sellers, yes, to lower the margin, they will be using the spreads. And of course, if you are a very good option seller and you have a decent technical knowledge, you could always initiate spread and make your living. You don't want to worry about the movements, etc., right? And again, with respect to spread, when you're starting, start with index. Don't go with stock. Initially, start with index. Okay, because a very good movement, volume, everything is there with respect to index. And stock, when you're doing, again, start with Nifty 50 stocks. Okay. So the other advantages, you don't want to watch the spread all the day. So as long you know your break-even number, right? In one case, it was somewhere around 1856. So as long Nifty is trading somewhere below 1856, you don't want to even look at the the movements, right? But if in case suddenly 100-point drop is happening and you are holding a bear call spread, okay, you will be having a decent profit. So that time you can see and book it. But the basic idea is, if in case you are an option buyer, you have to watch the movement every single second. That is not the case with respect to spread. And basically, the advantages with respect to spread, it is almost same for all kind of spread. So let me just brief on the generic one, and in the upcoming slide, we will skip the advantages if in case it is again repeating. Okay, and notably, if in case you are a beginner, I always recommend you to start with the spread rather than going directly with option buying or option selling. Reason is, here the risk is limited. Okay, you can argue like option buying as well, the risk is limited, but how many option buyers you know who haven't blown their account at least once, right? So don't start with option buying if in case you are a beginner. Just go with spread, as the risk is very less and there are huge advantages. Okay, coming to the disadvantages. Okay, so first of all, the biggest thing is limited profit. Let us say you are bearish on Nifty and your thought or idea is correct, and Nifty cracked by 100 points, 500 points, or even 1000 points. With respect to spread, let us say like the maximum profit is 2.6k. Even if Nifty cracks by 500 points, you will be gaining only this 2.6 profit. So that is one biggest disadvantage with respect to spread. The risk and reward are limited in most of the spread. Okay, that is a disadvantage. And next is always like when spread is on, let us say like again this bear call spread, one CE will be in profit and another CE will be in loss. Okay, sometimes what happens, you know, you might be booking the CE in profit and you would anticipate the CE loss to come down. It may not come and the loss might get amplified. Okay, so don't think too much. This is not I'm not saying you can't do, you shouldn't do this. You can do this. Once again, if in case you are good in technicals, you could definitely do this. Okay, maybe book the CE when Nifty is facing the next major resistance, and hold the CE short and reduce the losses. But again, don't try that in the initial stages. In initial stages, when you're exiting the spread, just ensure you're closing both the spreads altogether. And finally, this is the most important one, which most of them would not share. The greatest disadvantage with respect to spread, especially in stock option. Let us say like you are initiating a particular stock, 1000 CE bear spread. Now, so stock, we have only monthly expiry. Let us say like the stock in 4 or 5 days, it has gone to 1200. So you will be in the max loss already, right? And on one particular point, let us say the stock has gone to 1300. You would have taken 1000 CE and 1010 CE, these may not be trading, or let us say the buyer would be somewhere around 250 and the seller would be somewhere around 270. So imagine the lot size, let us say like a lot size is 500 here. If in case there is huge gap within this, then you will be forced to close with bigger losses. So this happens when your spread goes violently against you, especially in stock options. Okay, this will not happen in index options, because in index we always have volume. Even if it is a deep item, volume will always be in there. Stock, this happens, so just keep this in remember. Okay, even though textbook says spread the loss is limited, in this particular case nothing could be done. What we can do, if in case from 1000 it has gone to like 1100 and 100, and you know it is not going to come, don't wait till the expiry, just cut the losses in the initial part itself. Don't hold till the expiry where you face these kind of scenario. Fine. So we are going to start with the spreads. Okay, so we're going now, all the textbook stuff we are going to see. So these are the spreads we have. There is something called vertical spread, and these are the horizontal spreads. So what are vertical spreads? This is vertical, right? So as long as Nifty is trading within this particular range or within this particular range, you will be in profit. So this is called the vertical spread. So basically these four, bear call spread, bull call spread, bear put, bull put, all these are vertical, right? So it gives you a static number. As long Nifty or the particular asset is trading within this particular range, you will be in profit or loss. So calendar, diagonal, so those are horizontal one. Okay, diagonal is horizontal, calendar is diagonal. Calendar is horizontal, diagonal comes somewhere like this, that we'll discuss later. So calendar, it is with respect to two different expiry. Means on this particular time you would be expecting some trend, and after these many days you are expecting some kind of trend. Let us say like next week you are bullish, but the next week, let us say like budget is there, and let us say you are bearish. So that particular time you can initiate the calendar spread. That we'll discuss a little later. Now we'll start with the basic spread. So as I was saying, you could give too much preference to these two spreads in your initial days, because they are very easy to do, understand, and deploy compared to the other ones. Of course, these are like the mirror image. So compared to calendar and diagonal, vertical spreads are very simple and easy to learn and deploy. You can take a screenshot of this particular slide. So in vertical spread, okay, in put spread, we have bull put spread, bear put spread. Okay, so so the first word, whatever it is, that is the trend we are going to do, and the second is, so bullish trend we are doing with respect to put, bearish trend we are doing with respect to put. Okay, so this is what these words define. So in calendar we will be doing with the different expiry dates that we'll discuss little later. So these are the things we are going to discuss about each spread. What is the maximum profit, maximum risk, so when to use, and again the advantage, disadvantage we are not going to see too much, because it is common almost with all the spreads. Bear call spread. So this is what we are discussing. So as long, let us say like you have initiated here. Okay, so as long the asset is less than this particular value, you will be in profit, and if in case goes above this value, you will be in loss, right? So this is the horizontal one. Can you see? So it defines the range. As long it is here, you will be in profit, and as long here, you will be in loss. So in bear call spread, what we are doing, we are shorting one call, okay, and we are going long of other call. So we did that, right? And just ensure both of them should be same stock and the same expiry date. So this is what we are discussing. So in our case, the credit was somewhere around 53 points, right? So we shorted for 100 and 120, and went long for 71. So the credit was 53 in our case. So that is the max profit we are going to get. Spread we could do only in options and not in futures, G. Maybe you can do in cash plus options as well. Which market do you go for spread? We don't want to focus on what kind of market. When you know the trend, okay, or when the what to say, like theta decay is happening very much, you can initiate too much about the spread. Difference of a strike in stock, you could just pick the next strike. That's it. But whether it is Nifty or Bank Nifty or stock, just pick the next strike. Anyways, we can again see some more examples so that you will get a better picture. We'll complete the theory part, and again, last 10 minutes we'll go with some practical examples. Theory part, let me run down quick so that we'll spend more time on the practical part. Okay. Okay, so again here the maximum profit and losses limited in both the cases. So when are we going to use the bear call spread? See, when you understand or when you are able to predict like market is going to fall in the near term, you are going to initiate a bear call spread. So technically, if in case you see like Nifty is hitting an important resistance zone or anchor candles are coming. So what are anchor candles? You could check in our YouTube, Harmonics Traders. There we have deployed a strategy called anchor trading strategy. It is kind of positional one. So whenever those kind of candles comes, you could even initiate the bear call spread. And of course, we have this called ORT, right? I believe if in case you are with our if you're with our Telegram channel for a long time, you would know this. So every week we'll be sharing something called the ORT. So what is ORT? It's an option reversal positional method for all the week. So we have some values. So whenever those values come, you could initiate those trades. See, Harmonics 115.5. So let us say like so this week 18130 was ORT selling number, right? So if in case you have initiated a bear spread around 18130, that became a total profit for you. So Nifty closed below 18130. So if in case you have initiated a bear call spread, you would be in decent profit. So the question is like when to deploy whenever these kind of positional methods comes in. In very easy or simple terms, you could make use of weekly ORT because these numbers are valid for the particular week. So whenever these numbers come, you could initiate the spreads accordingly. Okay. Again, you could learn this video for free. So everything you could check from our YouTube videos. So you can just come and check here. So we have. I don't want to spend time here. You guys could come here and check for ORT and anchor those kind of videos. Yes, in range mode market, the spread works wonderfully. Again, once you know the technicals, when I say like technicals, once you know like you have got the major weekly top or weekly bottom, yes, again you could initiate the spreads. Okay. So it is not like strangle the spread, so you don't want to worry too much about the volatility as well. Okay. Fine. So this is an example. So Airtel, when we know like the major top is done, we initiated this bear call spread. And yes, we do have like an option selling paid service. There we'll be going with spreads because the loss is always limited there. So 850 CE we have shorted for 16.8 rupee and 860 CE we have gone long for 11.8. So the max profit is 4.7k and max loss is 4.7k. And what happened? That particular expiry, Airtel closed below 850, so you can see the break even, right? As long as Airtel is before 854, we are in good shape. On this 854, it should be at the time of expiry. So it closed below that, and 4,700 rupee profit was there. And if you just see, the amount needed was 35,000, which means you have got more than 12 or like 14% profit with a limited risk for a particular month. So for this particular month, if in case you've taken this trade and waited in this particular stock option, you would have generated 10% return. So that is a huge return compared to typical option selling. Okay. Like I said, spread, it is intermediate between option buying and option selling. It has got huge advantages. So once you know like how to master spread, you would be making consistent tension-free money. Okay, and of course risk-free as well, because risk is limited. Whenever you're doing a naked option selling or naked option buying, whatever you say, the risk is always high, right? And tension is of course very much high. So here you could make tension-free money. And who else could do spreads? Someone who has got huge amount of funds, he don't know like what to do, but he's not willing to take too much risk. Yes, he could initiate these spreads. So Reliance 2,400, 2,500 is max loss profit. So 2,600, see the immediate CE we are selling, and the far away CE we are buying. So credit is nothing but 69 minus 59, that is the credit. So somebody asked how to select the stock strike, right? Just go with the next available CE. So all those options you could get from the define edge site, which I showed to you. So these are the examples like where we got a 10% return. Advantages we have already seen. So let me just skip and go because we have multiple slides to see. Okay, so bear put. Now the trend is bearish. Now when we are doing the same thing using put, that becomes bear put. There is no high advantage with respect to bear call or bear put. Yeah, of course we have that particular strategy, that's it. Okay, so Bank Nifty, assuming the trend is bearish, what we are doing, we are buying the closest PE, and we are selling the out of money PE. Okay, so 272, 141. So whatever you subtract, that is the net credit. Okay, and again with respect to bear put spread as well, the profit and loss are always limited. So basically you need to know the trend, right? And got the max 4.2k profit as the trend was right. So like I said, the entry point or entry timing is very important with respect to spread. You could take the trades based on any of the positional methods. We have shared a lot of positional methods. You can start with basic ORT. Okay. Bull call spread. So this is again a similar one. What we are doing, we are buying CE and we are selling out of money CE. So this could be at the money or ITM, and the difference is the credit. So again, if you just see here, the risk reward is not that good, right? 2,800, 4,600. In earlier cases, it was like 5 to 10% difference, but here it is, the difference is coming good, right? So in those cases, don't deploy these kind of things. So that is why in very simple terms, I just said you could go with bear call and bear put. Okay, these are the examples. Advantages, disadvantages is the same in all the places. Now bull put. Questions I'll take at the end, friends. So we have like 15 minutes for the session. So we will try cover the theory part, and again we have to spend some more time on hands-on. Okay, so once you know this particular stock is bullish, so this we initiated this month at the starting. So we, based on technicals, we understood like the bottom has been done, and of course we can't take risk by going naked. Yes, we do naked option buying based on Harmonics GAN, the positional ones. When we have something for swing, yes, spread could be initiated. 1010 PE was shorted and 1010 PE was bought. 2,500 max risk and 3,400 rupees profit. And as of now, it has completed everything. So it has become, both of them have almost become 0. Dauber. So this we shared in our Telegram channel as well. So this based on Harmonics positional one. So 2,500 rupees profit and 3,600 loss. It is running with profit. Okay, so the risk reward is almost same. Okay, now coming to calendar. So calendar, it is going to be a little tricky. Pay attention. Okay, you just learn the basics part. Anyways, we are going to have one more session. We'll let you know on the date, because the strategy, it can't be completed in one session. So we'll be having our part 2, where we'll be coming up with more elaborative examples and details. So in very simple term, with respect to calendars spread, we need 2 different expiry. Okay, you can have one in this expiry and the other is next expiry, and you should be shorting or just deploying same strike. Okay, if in case you're going with 41,000 CE, Jan 25. Okay, this weekly or monthly expiry. This, let us say like Feb 2, the next weekly expiry. So it should be, both should be same. Okay, so 2 different expiry, and the asset should be with same strike price. So this is calendar. When this strike changes, let us say like 41 200, that becomes a diagonal spread. That's it. Okay, so a diagonal spread is nothing but a modified form of calendar spread. So these are called the horizontal spreads. Again, the max risk reward is limited in these things as well. A call calendar spread is purchased when the investor believes the near term is bearish. Don't get deceived. So here, call bearish, don't get deceived. That is how it is there in the textbook, and we are just going to just stick with it. Put when we go for bullish in calendar spread alone. Okay. So here just see Nifty 1800 CE, 1800 CE. So 17th November expiry, and this is like 10th November. So the immediate expiry we are shorting, and the next expiry we are going for long. Okay. So the ideology is market will immediately or initially fall, and then it will rise. And it went in our direction, and it gave the desired profit. The biggest disadvantage with respect to the calendar spread is the max loss we can't calculate. Our textbooks can't do that. The reason is, see, so this holds true only on this particular expiry date. Okay, but November 17th expiry, there is one more week, right? So the how all the typical calculation happens is based on this one. So don't just stick to this particular loss alone. For calendar spread, it might be higher as well. Okay, so that is why my recommendation is don't start with calendar spread. Just go with the bull bear normal spreads alone. Okay. Yeah. So in our second or the next part of session, we will be discussing more about calendar and diagonal. We'll spend some more time in hands-on. Let me carve up the textbook part with respect to calendar and diagonal. And you guys pick some stocks, pick some strikes. We'll deploy the spread, and we'll see what are the changes and the results. So this is how like the calendar break-even diagram comes. So it should be within a particular range so that we'll be in profit. So break-even always comes in range. As long as it is within this particular range, we'll be in profit. And this gave like a 2,000 rupee profit. So these are some examples. So with respect to disadvantage, the break-even can't be calculated. So this is spread in one word. Okay, so the vertical spreads are always easy to learn and understand. Calendar spreads are kind of okay. Diagonal, it is the most complicated one. So don't try diagonal in your initial days. So like I said, diagonal, so just take a snap of this. Yes, friends, so diagonal and calendar, it is little complicated. You just know the very basic alone right now. We'll be seeing in detail in the part 2. Okay. But from tomorrow, you can start with the vertical spreads. So we'll see some examples right now. Okay, so why this is called diagonal? Because it combines the horizontal spread and also the calendar spread. That is why it is diagonal. It is combination of both horizontal and vertical. So in diagonal, like I said, whatever calendar we are doing, when we change the strike, that becomes diagonal. Okay, so this is the classic example. Strikes are different, expiry date is different. Okay, so that is called the diagonal. And of course, you need to know the trend, or you need to anticipate a particular trend to happen, and then we'll be initiating the diagonal trades. Okay, so the final part with respect to adjustment, my first and foremost advice is don't do adjustment. Whatever losses is there, just book the losses. Okay, to do adjustment, you need lot of technical steps and you need lot of things to factor. Don't try this in the initial stages. You know the SL is like kind of 5 to 10% of your investment. Okay, just accept the losses and just move on. Yes, we can say like firefighting works, etc., etc. But for all these things, a lot of conditions apply. Okay, you need to have, you should be at least a good master with respect to technicals. But still, I am just willing to learn the basics of adjustment. You could roll over to next week. Whatever you have taken, you can just roll over to the next week if in case you are confident your position is going to win. Okay, and always the patterns keeps on changing. You need to know like what pattern is working right now. For example, right now we can say like Bank Nifty. Every single day, very easily it is moving 400 to 600 points. But if in case it's before 20-25 days, it was not even like 200 to 300 points, right? So market will be putting different kind of pattern every single time. You need to understand like what are the patterns and where you are supposed to do, fine? Okay, now I'll take your queries and we'll spend the remaining time in hands-on. Okay. Yes, kindly shoot your queries. Strategy, we will be playing with the directional view. I mean, the spreads basically you're doing with the direction. What is it? Okay. Spreads, it is always directional view. See, these straddle, these are the non-directional ones. Let's pick an example of strangle. Okay. So in today's session, we basically covered about the spreads. It's always directional. So this is non-directional one. So as long Nifty is in between 17,800 and 18,346, you will be in profit. Okay, the max profit is 2,300 and probability of profit is 69%, right? But loss is unlimited, right? That is the problem with respect to strangle or even straddle. Okay, in spread, loss is always limited. Excuse me. Right, the loss is limited. That is why we will be focusing more on spreads. And with respect to these strategies, so the iron contours over here, loss and all comes limited. Strangle, once you initiate a strangle and you are just buying the out of money CEP, then that becomes contour. Okay, so these stuff we can discuss in the upcoming session. So here you need not worry about the direction. Okay, so in fact you want a neutral market condition around this particular stage. In very simple words, when you know like market is going to be in range bound for a particular time, you could go with iron contour or iron fly because that comes with limited loss. If you have too much funds, you can go with the deep out of money strangle. If you're very good in technicals and if you're an intra player, you can go with straddle. If you're a fresher, if you want to try something, new and you want to do with the limited risk and you are happy with small profit, you can go with spread. Bear call and bull put, those are better. I'll just type in among all bear call and bull put, because selling option, that is always better compared to buying option. Bear call and bull put give too much importance. Spread is positional. We can do it for index intra, but we will not be getting too much profit in intra, bro. So we'll be getting the profit only at the end of the expiry. The tool which I'm using is this option strategy builder, and this is free. So we did that, right? So considering current Nifty example, okay, now we showed that, we'll show one more. Okay, now we saw in Nifty, let's pick a stock. Okay, so somebody tell a stock and say what trend it is. I mean, what trend you are thinking. Just type in some stock. And this recording will be available in the app. If in case you missed any part, you could just download our app. Our app is Harmonics Traders, and you could install and check this video. Okay. Type in some stock and what trend you want to be. And again, this is our Telegram channel, Harmonics Traders. Here you can join. Here we will be giving a lot of spread single side buying calls as well. You could join here and get benefited. And if in case you need any help, you could reach me in WhatsApp on this particular number. You can just take a screenshot of this particular number. So right now with this session, if in case you have any query, you could just reach me. And this video, it will be available in app. App name is Harmonics Traders. You could download from Play Store. And spread, do it in stock. Commodity, the options are not trading much, bro. Okay, so don't start in spread in commodity. Start with equity. Okay, somebody asked for Tata Motors. We'll check Tata Motor. Okay, Tata Motor. So what I'm doing, so this side, just go type Tata Motors. Okay, so right now, so see, it is clearly saying the selected option track is not, I mean, the movement is less. Let's pick a famous or commonly used one. Okay, I think, okay, once we initiate this, it will go. Okay, Reliance, let us say we are bullish. Let's assume we have picked something where the movement is there. Okay, now Reliance, the current price is 2443. Okay, so what you're doing, you are selling 24. Okay, it is coming towards this. Okay, so let us assume Reliance, you are bullish. I'm initiating a put spread. What I'm doing, bull put spread. I'm selling nearby P, and I'm buying out of money P. Now the credit is nothing but 35 minus 17. That is going to be the credit. Okay, so here by default it is showing 2460, 2420, right? So this is showing by default. So and the profit is 4,400 and the loss is 5,500. You could change the position. So 2460, right? In between we have 2440, right? Yes, you can just select that. Once you select that, just remember this number. It's a 4K profit and 5K loss, right? So this, both the things are going to get reduced. 2K profit and 2.6K loss. So this is what I said. Whenever you are going with the stock or index, just go with the next immediate strike so that the profit and loss comes reduced. Okay, always it is like 10%. The max risk. Okay. Yeah, any other query? Diamond strategy, it is for index intra players, bro. Magical wave, harmonics you can use for commodity. Okay, with respect to spread target, you are supposed to wait for wait till expiry. Sometimes in 2 or 3 days you might get a decent profit. If you feel the profit is good and comfortable, you can book that. Okay, somebody asked Bank Nifty an example. We see that. No, there is some bug in the site, it seems. So whether it whatever I select, it is something like this. Anyways. Okay. So Bank Nifty, somebody asked how do I need to go? Whether the next immediate strike, like I said, you can just play around the site. So here it is like 400 points difference. Profit is 4K and loss is 6K. Just change the position. So instead of 400, you just have it as 200, 4K, 6K. Just see 2K, 2.8K. Okay. So again, you can do this adjustment in a way. This comes somewhere around 2 to 3K, both profit and loss. If you happen it very close, sometimes you will be getting 800 rupee profit, 1000 rupee loss. Okay, just try to go with whatever is the investment amount we are having, at least 10% as target. You could have the strikes chosen in that way. Okay, now let's again come closer. 2600, 2500. I mean 4000, 42,500. See, this is what I told. So 1000 rupee profit and 1000 rupee loss. Okay. So if you're very conservative, you could risk only 1K. Yes, you can do this. But the basic funda is whatever is the amount invested, just try at least a 10% target, which means 2300, close to that. And your SL as well, it should be like kind of close to that. Okay. So see, basic ideologies, you need to know the trend. Okay. Once you know the trend, okay, and once the particular number comes, you could initiate the trade. Since somebody asked, I'm just giving an example. You can start with this ORT. Okay, so this ORT is weekly support and resistance basically. And whenever like ORT sell comes, you could initiate a bear call spread, and whenever ORT buy comes, you could initiate a bull put spread. Fine. So you could just subscribe to our YouTube channel Harmonic Traders and check this ORT video. You could use Anchor as well. For intraday, I always recommend go in ITM with small SL. Okay. Again, spread. This is for the beginners or who has got a good amount of fund and want to do with limited risk. What is decent pop? Is there any strategy for buy? You need to know the basic technicals, bro. Of course, you can do option buying. I'm not denying that. If in case, I mean, you just if you come to our Telegram channel, you could see multiple examples of option buying. Even today, we went for long. We always go like one side in 80% of the cases. So once we know like Bank Nifty, the sell got triggered, we went ITM, just see how much ITM we have gone. 43 200, and it gave like 2K profit, and this is based on our course magical way. So here we give leading indicators and method, and based on one method in this particular strategy, Bank Nifty sell got triggered. Once the sell got triggered, we will be going ITM with small SL. Okay. So yes, you can just check here where you could get a lot of single side calls, and you will have most of the charts or reasons as well. Okay, so there you could just check and get it. Probability of profit with respect to spread, it is more than 65 to 70 if in case you are decent with technicals. And again, my general advice, don't do too much firefighting in your initial stages. If in case your SL gets hits, just accept the SL, right? Of course, if you know like good technicals, you could make use of any of the positional methods for your exit. Now, let us say you are let us say you are holding CE short and long. Okay, market is moving up and long it is in profit, short is in loss. You know, like let us say like Nifty 18500 is a psychological resistance and some positional sell is there. So what you can do, this long you can book the profit and you can hold the short. Again, just ensure you place some SL here, but don't do this without any knowledge. So these are the ways where you could apply technicals and try make more profit in spreads. But again, that is kind of risky and spreads are not designed for that. Spreads are designed with limited risk, so just follow the rules. Oh, okay, fine. Okay, friends, I think we are good. So if in case you have any queries, you could reach me through WhatsApp and just check our YouTube channel to learn the positional methods. And whenever those positional methods comes in, you could initiate the spread. So this is just part one. So we just covered what are the types of spreads available. Diagonal and the calendar, it is a little complicated. Don't do it in the initial stages. Again, we'll be explaining more about diagonal and calendar and the other things like iron condor, iron fly, all those strategies in the upcoming sessions. Okay. Yeah, yes, for option selling margin will be more. So that is why whenever we're initiating the spread, we first buy and then we sell. Okay, so if in case you want to initiate this particular spread, you first buy 42,500 PE and then sell 42,600 PE. Anyways, you just play around in this particular site. Whenever you do the adjustment by yourself, you will be learning it for fast. Instead of spending time with too much textbook or the theory part, just keep switching these numbers. Okay, and you will know like how it is getting changed. Again, you could see the probability percentage as well. So just keep an eye on that as well. Okay, just don't initiate any strategy where the probability of success is less than 40%. Okay, it should be above 50 in all the cases, but don't go if in case it is below 40. And whenever you're exiting, just exit full position. Don't exit one position and hold the other position. Sometimes it might work, sometimes it may not work. Don't do that. So better just exit both the position at the same time. Again, there are a lot of tricks you can whenever let us say like you have shorted for 100, okay, and you have gone long for 50, okay, and on one particular point of time this 100 have become 10 and this 50 have become 5. Okay, let us say it was a case like things are extremely in your favor. Now you can exit this and you can hold this. Why? Whatever happens, only 5 points. I'll put in this way. This is short and this is long. Okay, and 5 points you're going to lose. And sometimes again, if this particular entry point is in favor of this one, even this could go to 10 and you could make some profit. But again, these are we'll hold these for the next or upcoming webinar. We don't want to put too much info on the first the basic webinar itself. So we do have like multiple options with respect to exit. But again, textbook rule: whenever you're going for exit, just ensure you're closing both the things at the same time. Just one lot sell and one lot buy. Okay, friends. Thank you for your time. We'll catch up sooner in the upcoming session. Always trade with small stop loss. Take care. Bye-bye.